Hi, my name is CH. I have worked as a managed investments product specialist in Singapore for over 15 years and would like to offer, through short video courses, the investments related knowledge that I have picked up throughout the years to anyone who is keen to learn more about investments. This video is part of a series of videos focusing on providing basic yet detailed knowledge on mutual funds for Singapore-based or Singapore-booked investors. In this video, we aim to cover and explain how mutual funds define their investment objectives and strategies, as well as the importance of benchmarks. Mutual funds typically state a short objective and a longer, more detailed strategy. Sometimes these are bundled or rephrased into an investment description as well. All these essentially define the purpose of the fund. The fund objective normally exists as a simple statement that says what it aims to do. This is pretty much like saying, I want to be a soccer player, when your primary school teacher asks about your goal in life. Most of the time, this can be simplified into either aiming to achieve capital growth or to achieve income generation, or both. Further simplifying it down to its essence basically means that all funds aim to increase the value of the investments over time. The objective of a fund will typically state that it invests in a certain market. This defined market, which can be represented by an index and serves as the benchmark of the fund, is the market that the fund aims to outperform, regardless if it is worded directly or indirectly so. For example, a US large cap equity fund may use either S&P 500 index or Russell 1000 index as its benchmark, given that both indices are popular and commonly used to refer to the US large capitalization stock market. The benchmark gives guidance to investors on what the fund is trying to compare against and outperform on, as well as an idea on what market exposure that the fund is expected to mainly have. Using back the soccer player goal example, your benchmark could be David Beckham, or Messi, or Ronaldo. You basically want to reach a level that is as good as them, if not better. Given that mutual funds typically have different investor share classes that come with different fee structures, some funds will define an outperformance target against the benchmark as a gross number, which means it is before fees are deducted, while some others will define it as net of fees, which are usually based on institutional share class fee structure. Investors should always assess a fund by looking at net of fees performance in accordance to the share class that they invested in, because that is what the investors would receive in the end for their investments. Sometimes, a fund will provide more details on the intended market exposure to be more specific, or in case the benchmark may not be familiar to investors. Some fund objectives will also indicate a time period, which is usually either stated as 3 to 5 years period, or over a market cycle, which means going through a market bull and market bear period to average out return expectations. This is necessary as the fund managers are taking active investment bets all the time to adjust the fund portfolios that may lead to a good performance in one year and a bad one in another year. What's important is that over an extended period, in this case about 3 to 5 years, the fund can on average deliver outperformance against the benchmark. This is also a reminder and caution to investors that investing in mutual funds need a mid to long-term investment horizon and is not suitable for investors looking for quick gains within days or weeks. Some funds will also specifically mention in the objective any additional investment tools and approaches, such as using derivatives or currency hedging. Let's take a quick look at an example of a fund objective statement. The fund aims to provide capital growth in excess of the MSCI China Net Total Return Index after fees have been deducted over a 3 to 5 year period by investing in equities of Chinese companies. Here, we can clearly see that this fund is focusing on capital growth only, meaning the fund will likely tilt towards higher growth companies instead of value or high dividend companies. This fund is also focusing only in Chinese equities, and the specified benchmark is MSCI China Net Total Return Index, where then investors can do their own research on this market index to find out more if needed. This fund also states that it intends to perform better than the benchmark net of fees, but without saying at least how much better. Last but not least, it does state a 3 to 5 year period to assess its performance, as equity investing can be volatile. The investment strategy, or sometimes termed as investment policy, gives more color on how the fund intends to achieve its objective by providing details on what it intends to invest into and what are its associated investment guidelines. Using back the soccer player goal example again, your strategy might be to join the school soccer team and win school tournaments, then go for national team selection, then win the SEA Games, then go for World Cup. As the investment strategy can be lengthy, this is normally found in the prospectus only. A mutual fund is an actively managed investment product, which means the fund manager needs to do something different from the benchmark in order to have a chance to outperform the benchmark. Through the investment guidelines within the investment strategy, we can get some insight on what are the given flexibilities to the fund manager for this purpose. Using a typical Asian equity fund as an example, its strategy would likely state that it would invest at least 70% into equities of Asia Pacific companies excluding Japan. Stating Asia Pacific excluding Japan provides the core exposure of the fund and as well the intended market benchmark. The minimum 70% allocation ensures the fund remains highly correlated to the market benchmark, while the remaining up to 30% exposure gives the flexibility for the fund manager to do something different in order to try to outperform. This can be investing in regions outside of Asia Pacific, or taking indirect exposures through derivatives, or even the ability to hold certain amount of cash during bearish markets. Most funds will indicate what it can invest using this non-core allocation. Other details available in the investment strategy include the different aspects of the market that a fund might be focusing at. For example, an equity fund might have a tilt on growth companies versus value companies, or a focus on large capitalization companies instead of mid and small capitalization companies. The investment strategy often elaborates more on the intended market exposures if the access to the market is not straightforward. For example, a China equity fund may indicate how it intends to split the investment across China onshore and offshore markets, as well as how it intends to access the somewhat restricted China onshore or A-shares market, such as through the China Stock Connect scheme or the Qualified Foreign Investor scheme. Derivatives is a common mention in fund strategies, though it should usually be only for risk hedging purposes or for portfolio efficiency purposes. That being said, there are some funds that use derivatives, such as call options, specifically as part of their strategy to generate performance. Holding cash in a fund has mixed views among investors. Generally, we would expect a fund to be fully invested, so that it fully utilizes the cash to generate returns. However, at the same time, we also know that in a bearish market, where majority of investments turn negative, holding some cash in the fund helps to reduce the losses. Therefore, All funds will typically indicate that they may hold a small portion of the portfolio in cash, with some funds specifically indicating a maximum level of allocation to cash, so the fund remains highly invested all the time. ESG and sustainability factors have been a prominent investment topic in the past decade. Therefore, most funds have already established some form of sustainability scoring or guideline in their company processes, and therefore will indicate this in the fund strategies as well. On a similar note, some funds will also indicate certain specific types of companies or sectors that they will not invest into, such as military-related companies. We mentioned about benchmark being an important factor in a fund objective and strategy. To reiterate, the benchmark is the guiding light and a hurdle for a mutual fund, as the fund needs to firstly stay close and relevant to the benchmark in terms of its investment exposures, and secondly, needs to ultimately be able to outperform the benchmark performance over a reasonable time period. Benchmarks are typically defined using one market index or an allocation of several market indices. There are many indices out there, and matured markets usually have several different indices available. For example, for the US equity markets, there are S&P 500 index, various Russell indices, various MSCI indices, and several more from smaller index providers. Benchmarks for newer markets can be sometimes problematic, as these markets are still developing, and therefore different index providers may have a different approach to defining the index compositions, leading to indices pointing to the same market but with different underlying companies and having different performances. Many thematic markets in their early days face such problems. As a result, a fund investing in a new market can potentially deviate quite significantly from its benchmark, which is something an investor should take note of. Another aspect for investors to be cautious of is when a fund chooses an unfamiliar index as a benchmark, when there are more commonly used indices available for the market exposure. There might be a genuine reason for the selection, and the fund should mention that reason in an investor document for assurance. Otherwise, there might be a risk of a fund manager trying to pick a poorer performing benchmark in order to appear to deliver good relative returns. Do study such funds more before deciding to invest. There are basically three ways for a fund to overcome the hurdle, which is to outperform its benchmark. The first is to identify positions in the benchmark that have a higher likelihood than the rest to perform well, and invest more in these positions. The second is the opposite, which is to identify positions in the benchmark that have a higher likelihood than the rest to perform worse, and invest less in these positions, or to avoid them altogether. The third is to identify opportunities outside of the benchmark that can potentially perform better than the benchmark and allocate to them. A good fund manager and his research team should ideally do all the above three, with as high success rate as possible. Given this is an ongoing task to manage the fund portfolio, this is what we mean by active management in mutual funds. Now that we understand more about fund objectives, strategies, and benchmarks, how do we look at a fund's performance from an investor's perspective? The first thing to look at is not the fund, but the benchmark. You should be buying a fund because you want to get an exposure in a certain market, not the other way around. Therefore, understanding the benchmark's performance is crucial and forms your basic expectations of what your investment returns and volatility would likely be. After that, look at the fund's performance and see how it compares against the benchmark's performance. It should ideally be similar and slightly better over time. Some funds provide statistical numbers in their fact sheets to help you with this assessment. Beta is a number that provides guidance on how far the fund deviates from the benchmark in terms of volatility. A 1.0 means it is exactly the same as the benchmark. Lesser than 1 means lower volatility, and vice versa. We would like a fund to ideally deliver better returns with lower volatility. Hence, we would normally prefer the beta to be lesser than 1. There are funds that take higher risk instead to generate returns, leading to a beta higher than 1. In such cases, we would then have to assess if the returns are worth the additional volatility taken. Another statistical number often seen is alpha, which refers to a fund's performance difference compared to the benchmark's performance. A positive alpha means there is outperformance, and therefore we would always prefer consistent and positive alpha returns in a fund, which makes the fund fees worthwhile. Last but not least, there is another popular statistical number called active share, which is a calculation of the difference in holdings in a fund portfolio compared to the benchmark. A higher active share means the fund's portfolio has more holding differences, which suggests that the fund manager is trying to actively tweak the portfolio to try to generate outperformance. That being said, a high active share does not necessarily translate to positive alpha, especially if the fund manager ends up taking wrong bets to make the returns worse. Let's run through a quick exercise using JP Morgan America Equity Fund as an example. The fund's objective is to provide long-term capital growth by investing primarily in a concentrated portfolio of US companies. The benchmark defined is S&P 500 index. Therefore, we know the fund is primarily investing in US large-cap companies. We can see both the fund's performance and benchmark performance together in table format and graph format. It can be clearly seen that the fund has had its hits and misses on calendar year basis, with some years doing better than the benchmark and some years worse. Looking at annualized basis, we can see the fund is slightly better than the benchmark in 3 and 5 years, but worse in 10 years. This means the fund has been better in the recent 5 years, but not before that. It is worth noting that the performance differences are only less than 1% on annualized basis. Additionally, the graph shows the fund has been performing quite close to the benchmark and only managed to have a strong outperformance in 2023. On statistical numbers, because it is referring to 3 and 5 year periods, which the fund had done relatively better, you can see positive alpha and also beta slightly lesser than 1. Overall, it is not an easy feat to outperform a highly efficient US large cap market, so the overall performance numbers here are certainly decent. What is then useful for an investor to think about is that firstly, whether the fund can continue its outperformance from 2023 or revert back to its weaker earlier days. And secondly, whether the slight outperformance compared to the benchmark is worth the investment, especially if there are high subscription fees to buy the fund. Hopefully, this exercise and the contents in this video have given you a better overview and understanding of how mutual funds define their investment objectives and strategies, as well as the importance of benchmarks. This concludes this video. Do check out my other videos to find out and learn more about mutual funds. If you find this video useful and would like to see more related contents, please click on like and subscribe to the channel, as well as share this video to someone else that might find this useful too. Last but not least, if you spot any mistakes or inaccurate information in this video, or have any suggestions to help improve this video, please do drop a comment below. Thank you and have a great day.